Wouter, great to have you with us today. We can talk more about tech in a second, but I just want to get a broad sense of your view around US markets, because you've actually added to US equities this month. Why is that, as people start to question whether the rally has further to go as we begin the earnings season?
It's really a combination of a relatively modest growth environment with low inflationary pressures and what we think will be a global easing cycle in monetary policy. That combination is, to us, a pretty powerful one, and one that we think the US equity market will be particularly good at profiting from. So those two factors have really driven us to increase our risk. We're still not at our maximum risk budget. We're about halfway there, but it is, for us, a step in the right direction, so to speak, to make sure that in this environment we have enough risk on our book to profit from what we think will be a good environment.
How important are buybacks? I mean, we see the big buyback announcement from Alphabet, but in general, buybacks have really slowed down in the first half. Do you expect them to pick up again?
No, we don't actually. In terms of our buyback projection, we've actually modestly decreased those expectations. So we think buybacks will still be a tailwind to the US equity market, but to a smaller degree than they have been for the past year or two. But still, then, looking at the general backdrop, it's really about the valuation levels that we think are still going to be supported by this low inflationary, low interest rate environment. That's really the driver of our positive outlook.
Wouter, I want to talk about Einhorn, who's betting against US high yield and investment grade debt. And, you know, part of this is basically providing a hedge for the firm's bullish equity positions. Now, you're still positive on high yield. Tell me whether you're more positive and you have more conviction on high yield against equities, because you've talked before about the fact that high yield has got more benefit on the upside than there is loss on the downside compared to equities. Is that still your position?
It still is, but it's sort of a risk mitigation trade for us. So because you have a certain amount of risks to spend, and if you spend it in equities, it goes quickly. So instead, what we chose to do, we took some risk in equities, most notably US equities, and the rest of the risk we chose to take in high yield because of that upside-downside benefit that it brings. It just has less downside risk to it. So that's one reason, and we're just not negative on the credit side at all. We think the supply-demand characteristics right now in US credit are very favorable, and we think that's going to keep spreads very tight. So we are maintaining that overweight to high yield.
How important is the GDP number today, and what are you expecting?
So it is important because you want to know if the domestic economy is indeed ticking over the way you want it to, because we all know that the international part of the economy is weakish and the manufacturing side is weakish. So it's really that domestic part of the economy that you want to show resilience. So that's what we're going to be looking for in the GDP report. It is a backward-looking report. We know that about the GDP number, but still you want to see that confirmation. So it is important to us. However, in terms of our overall expectation, we think modest growth is really the environment here. So we're not expecting for a very strong GDP print at all. It's about modest growth, low inflation, low interest rates. That's what's driving our view.
And that means what for your view in rates? So I can understand that you are tilted towards risk, but what about the rates? Are you preferring duration? We are still slightly overweight duration. We still think rates are going to be very low. We think there's a global easing cycle in monetary policy that's coming, and we've basically seen those statements from the ECB, from the Fed, and from three central banks last week on the emerging market side, and of course Turkey as well, but that's a different story. So we are seeing that global easing cycle develop slowly, and we think that's going to be positive for duration, and we think rates are going to stay low. We think the 10-year on the US is going to go below 2% and stay there, and we think Japan and the Bund will stay in negative territory as well.
What sign do you want to see, Wouter, to take profits then? What needs to happen for you to say, I'm selling US stocks?
I think one thing that's really a risk to our outlook is inflation. So if inflation starts ticking up and therefore the Fed can back off the easing cycle, that would be certainly something that we'll take very seriously in terms of a driver of taking some risk off the table. So if we're wrong on inflation, or if we see signs that inflation and particularly wage growth start to accelerate, that would be a time for us to be a little bit more careful with our risk position.